Legends, welcome back to another video. Before you guys get into the video, real quick, I want to let you guys know how the video came about. And so I was doing a one-to-one session earlier today with a legend named Chris. Shout out to you, Chris, in which we were reviewing the difference between a continuation pattern and a reversal pattern, but more importantly, taking a look at the effect of how the smaller time frames can confine a viewpoint compared to looking at structure from a longer time frame perspective. And so take a look at one of the examples that we were reviewing, guys, and if you guys enjoy the video, definitely leave a like as well as a comment on other videos that you want me to do in the future. Once again, shout out to Chris for allowing me to take a section of the one-to-one training and the recording that we were doing today and allowing for me to post this and leave this open to the public. So I hope you guys enjoy this, and without further ado, guys, get right into it. A trend will always start with a sharp movement, or as we like to call it, an impulse. And how many points does this have, Chris? 2 or 4? This here?
Oh, no, 2.
This has 2, right. And so at the same time, you know, we always want to factor in that with an impulse, someone is always making money in that push, right?
Mm-hmm.
So with every impulse, we're always expecting what?
Pullback or relief.
Right, profit taking, because someone's got to take profit at some point. And at the same time, always remember it's not healthy for economies to push in a certain direction for X amount of time.
Correct.
And so looking at it as of right now, we're always expecting some type of liquidation or relief, which actually formulates our third point, which is our higher low. And then once we break out of the highs, we start to formulate a trend, which creates our higher high, right?
Right.
So now, Chris, now you understand why, you know, this is called a bull flag, or what they call as a continuation pattern, because it's telling you that the trend is continuing of that initial impulse, right?
Right.
Now, looking at the counterpart of it, what did we learn in this example here? How many movements does it need?
4.
Correct. So if we look at its counterpart, we start with an impulse which has how many movements?
2.
So what happens when it does this?
What's a reversal pattern?
Right. What's the difference between example number 1 and example number 2?
Example number 1 is continuation trade.
Why?
Because it has 4 points, a low, a high, higher low, higher high.
But not necessarily because of that, but what happened after this?
You got relief.
Right. What more importantly, that we got profit taking. Someone took profits.
Okay.
So what's the difference in example number 2?
No one took profit yet in 2.
Right. Right. And at some point, we are expecting this to liquidate or take profit, which means that this could turn into what we call a continuation pattern.
Okay.
Unless we break the entire beginning of that impulse. Do you know what I mean?
Yes.
Now, the reason why this is called a reversal pattern and it's not called a trend, and this is called a trend, is for one reason. Different time frames will cause you to be subjected on the viewpoint and things of this nature. Let me give you an example. If you look at dollar index right now, is it a reversal pattern or a continuation pattern?
Reversal pattern.
Right. But some would argue to you, Chris, and say, well, how could you say that? It's in an uptrend. You have a low, a high, a higher low, a higher high, a higher low, higher high, higher low, same highs, higher low, right? But they would be like, Chris, how could you say that? We're in a trend, right?
Uh-huh.
And, you know, the answer to all of this is the smaller time frames give you a skewed viewpoint. Why am I saying that? Look what happens as I start going into the longer time frames. So now we start to see more of the structure. Still looks like a trend, right?
Yes.
Okay. But then we go to the weekly. Okay. Now it looks just a bit more impulsive, but still a little bit like a trend, right?
Yes.
Now we go to the monthly. What do you see?
There's an impulse.
Right. So what did you just learn from there? From the smaller to what prices and why it's actually called a reversal pattern now?
Smaller time frames show you a skewed view, and larger time frames show you what's truly happening in the market.
Precisely. And the whole point is the reason why, and that's why it's validated, and that's why it's called a reversal pattern versus a continuation pattern, right?
Right.
I'm just writing it down. Because the whole point is, if anyone ever tries to argue with you and say, Chris, well, you're wrong. You know, a trend doesn't need that. It's very obvious that this is an uptrend. And you would be like, no, you're just, you're just naive, because a trend needs 4 points, just as this downtrend had a high, a low, a lower high, and a lower low, right?
Yes.
Same concept here. This just has a low and a what right now?
So low and then a high.
Right. So what do we still need?
We need a higher low.
And then a
Higher high.
And if we don't get this, then it tells you who's actually in control.
It'll still be sellers in control.
Right. And therefore, this is all treated as what then?
Relief.
Beautiful, right? So now you start to understand, and you start to see, well, okay, now it makes sense of why, we need to see liquidation, profit taking, and things of this nature, simply for the fact that, on the smaller time frames like daily, it may show that, it looks like a trend. But in reality, we call this a reversal pattern only for the fact that as we start to take a look at the longer time frames, let's just push back to the monthly, we just see it's a straight push. That's it.
Right.
So that's why, in the end of the day, we need 4 points. That is why this needs to pull back at some point. But that is the difference between reversal and continuation.